This recording is actually a big review of MixMax, or actually, if you did not have Intermediate 1 at Park, it's going to actually teach you how to do the MixMax case, which is really converting accrual basis accounting to cash flow. So let's talk about getting started. What are we trying to do? Well, in this particular assignment, what we're really being asked to do is convert accrual basis accounting to cash basis accounting. So if you look at typically when an accountant goes to prepare the cash flow statement, which is, converting accrual basis accounting on the income statement to cash basis on the cash flow statement. Well, the accountant doesn't actually go to the cash account. If you think about it, we could just go to the cash account and look at all the numbers there, but there would be lots of them, right? Cash is the busiest account for a company. There could be hundreds, thousands, millions, billions for some companies that do a lot of transactions. And you'd have to go in and look at, for each debit, was that an operating cash flow, an operating activity? Was it a financing activity? Was it investing activity? And the same thing with the cash going out. Was it operating? Was it financing? Or was it investing? And if there were millions of those, it would be enormously time consuming, wouldn't it? So that's not what we do. We don't go to the cash account. Instead, we problem solve for the cash flow statement. And this is how we do it. We know the beginning balance sheet, right? Because usually a company presents comparative balance sheet, beginning and balance sheet numbers. So we know the assets, liabilities, and stockholders' equity at the beginning of the period. And we also know the ending balance sheet for those amounts as well. So recall the balance sheet is at a point in time. So at click, right? Click, like a snapshot. Click, here's the financial position at the beginning of the period. Click, here's the financial position at the end. Now, the financial statements tell the story. What happened to these accounts from the beginning to the end of the accounting period? And that story is told through the income statement, right? Because the income statement, recall, covers a period of time. So this tells transactions that took place for revenue and expenses from the beginning to the end, and also the statement of cash flow likewise covers a period of time. And you will notice these statements are dated for period ending, where the balance sheet is at a point in time. So at 6/1, at 6/31. Okay, so here's what we're going to do. What an accountant will do is we'll take the beginning and ending balance sheet, and step number 1, we're going to solve for the difference in those. So we're going to figure out, what happened, like accounts receivable. Here at MixMax, I can see it went up $4,000. So we'll do that for every balance sheet account. Once we know that, we're going to put that in our T accounts and figure that out. Then we're going to look a little closer at what caused those changes. Well, we'll know the income statement because we have had accounting records track revenue and expenses all through the period. So the second step is that we will, sort of journalize, if you will, but it won't be a formal journal entry. But we'll figure out what were the journal entries for the revenue and expense, gains and losses on the income statement. And then by default, in each of these accounts, the only thing that will be left are cash flows. And so by default, we'll solve for cash flows, okay? So we're going to get started in doing that. Well, the first step is solving for the change in the balance sheet. Well, I have to know beginning and ending. Now, here in the MixMax case, if you didn't start at the beginning with us in Intermediate 1, we're kind of picking up, here in June, where we've already, in Intermediate 1, completed about 5 of these cases. So if you're just starting out, you're going to see that MixMax likes to make sometimes these beginning and ending balances a mystery, a puzzle. And it's a really good experience for students because it really makes you think of how the financial statements are interconnected. So let's go through and see if we can solve for these question marks. First off, total assets. Well, that one's pretty easy because the balance sheet tells us total assets equal total liabilities. So if this is 139,970, this is going to be 139,970. Now, how do we get accumulated depreciation? Well, it's said to see the notes. Well, in the notes, it tells us that they got rid of, or they sold, the truck. They sold the truck at the end of June. So if I was trying to figure out accumulated depreciation at the end of June, I would not include the truck, right? Wouldn't have any. But the wagon, 14,400, again, earlier we said market value is irrelevant. So salvage value, you should have gotten, when you did your Excel spreadsheets for this assignment, monthly depreciation, 14,400 minus this, divide by 5 years, or 60 months, if you will, to get a monthly, you would have gotten $216 monthly for the wagon. Again, cost minus salvage, and I get a dollar amount, and then I divide that by the 60 months, 5 years, which is 60 months. And you'll get $216 monthly. Now, this is the end of June. So 216, I'm going to take that times 6 to get my accumulated depreciation, and that'll be $1,296. Okay? Then we can do the automobile as well. So cost less salvage, divide that by the 60 months, and I'll get $189. So the monthly depreciation is this. I'm going to take that times 6 to get the accumulated for the end of the June. So 1134. So accumulated depreciation for MixMax at the end of June should be 2,430. And let's go put that up here. Okay. Now, if I know everything except cash, so, you know, this plus that equals 139,970, I can solve for the one unknown. Cash must have been $44,000. Okay? So all of these have to total to 139,970. Well, in order for that to happen, cash has to be 44,000. Okay, so we've solved for that. Let's go a little further. There's also some question marks, I believe, over here. Yes, there is. So the income state's fully complete, but we actually have some unknowns on the cash flow statement. So they want to know the decrease in cash. Well, where would I find that? Well, I can go back to the balance sheet. It went from 47,975 to 44,000. That is a decrease of 39.75. So I'm going to go put that 39.75, and again, that's a negative, 39.75. So now 18,102, 1873, you know, plus what? This has to be a positive 16,000. So we've got operating, financing, and now investing activities are 16,000, and that would be the sales price of that truck. Sale of property, plant, and equipment, which is actually, recall, they sold the truck. They told us on an earlier page. Okay, so we have filled this all out. What we're going to do in our T accounts is we're going to problem solve how did MixMax get these numbers for the cash flow. So we're not doing the transactions during the month of June. We're pretending, you know, MixMax has already done that. We're the accountant coming in at the end where the balance sheet and income statement's been prepared, and we're going to solve for this, but in this case, really, they're giving us check figures, aren't they? We know this is what it's going to turn out to be, but we've got to figure it out ourselves. Okay, why don't you, I'm going to stop your recording and go ahead and fill out, solve for all these changes, like the allowance for doubtful accounts. That went from 41 to 5,600. That's actually an increase, but with it being a credit account, right, it's a contra account, we'll put that in brackets, 1,500. Okay, so go ahead and finish this out. Okay, so if you're back in, let's go over what you came up with. So cash is a negative 39.75. Accounts receivable went up 4,000. The allowance for doubtful accounts would have had a credit increase, and I want to make a point. the account actually went up, but it's a contra asset that caused total assets to go down, and that's why I'm putting brackets around it. Total assets went down, but the account actually went up as a credit of $1,500. Inventory went up $6,000. Prepaid rent went down $500. Property, plant, and equipment went down $18,000, and accumulated depreciation went from $33.75 to $24.30. Notice I had overlooked putting those brackets around there. And so that is an increase. It actually decreased, but because it decreased, it caused total assets to go up. So I'm going to make a point here on these two contra assets. They both cause total, in this case, the allowance account went up. When it goes up, total assets will go down. And I'm really looking at the difference over here for total assets. Likewise, accumulated depreciation actually went down. It went down, but that's going to cause total assets to go up. And that's why I'm putting it as a positive here. It's a positive number. So again, accumulated went down, but I put it as a positive number because total assets will go up. Again, those are the two contra accounts. Okay, then accumulated liabilities and stockholders' equity plus $3,500, $3,551, -6, -24,400, -573, positive 198, nothing, and then 4,700. And in both cases, the changes total 13,030 or -13,030. Okay? Now, we're going to take these numbers, these changes in the balance sheet, because this is step number 1. I'm going to take these changes and put them in my on my worksheet. Okay? So let's go over and do that. So on this worksheet, notice it's got stockholders' equity, and that's intentionally positioned close to the income statement. The assets are in these two columns, and liabilities over here. And then I went ahead, because we know, assets minus liabilities gives us stockholders' equity. And I went ahead and put arrows for the debit-credit rules. Stockholders' equity accounts go up with credits, assets go up with debits, except the two contra accounts, those go up with credits. And then liabilities over here, all of those go up with credits. So just a nice little reminder of our debit-credit rules. Not that anybody really needs it, but it's kind of helpful to have those there when we're problem solving. So now I'm going to go put in the changes. Cash went down, so I'm going to put that on the downside of cash, $3,975. So I'm going to enter it there. And then accounts receivable went up $4,000. And the allowance for doubtful accounts, remember it went up, but it, I have it as a negative on the balance sheet, but when I put it over here, the account went up on the credit side. Okay, so having to be careful there. And again, I want to go over here to the balance sheet. Notice the allowance account actually went up. It went from a $4,100 credit to $5,600 credit. That's an increase in the account itself. But we put brackets around it here because it causes total assets to go down. But when I go to the T accounts, I want to put an increase on the credit side. Okay, and then inventory went up $6,000, put that on the debit side. Prepaid rent went down, so on the credit side. Property, plant, and equipment went down $18,000. And accumulated depreciation went down, and I had it on the positive side on that balance sheet difference column, but that's because the account went down, and it went down $945. Okay, and then going over to our liabilities, just enter those in. Interest payable went down 6. We didn't even have dividends payable. Accounts payable merchandise, notice we have 2 accounts payable, one for goods, one for services. And the services are for things like utilities and salaries and that sort of thing. So this went up $3,500. This one went up $3,551. Current portion of debt went down $573. Taxes payable went down $24,400. long-term debt, nothing happened to it, and our deferred tax liability went up $198. Let's go over to retained earnings. I didn't get my line there. It went up $4,700, and then nothing happened to common stock, so nothing there. Okay, so we have entered in the changes. Now, the other thing, at this point in time, you should go to all the debit changes and add them up. So the 4,000 plus the 6,000 plus 945 plus 6 plus 573 plus 24,400. You should add those up. You're going to get 35,924. The other thing I want to do is then let's add up the credits. So 4,700, 3,975, 1,500, 500, 18,000, 3,500, 3,551, and 198. And you're also going to get that to total 35,924. So before you go any farther in this case, make sure that your debits and credits equal. Okay, so there. Okay, the next thing we're going to do is go over here and enter in the income statement. So I'm going to skip back over here. Remember, step 1, we looked at the change in the balance sheet. Step 2, we're going to start problem solve for what caused those changes. Well, one of the things that's going to cause the change are these transactions on the income statement that occurred during the period. So we're going to go over here. We're going to make a journal entry for sales revenue into the T accounts. So let's go make that journal entry. So we saw that sales, so we're going to create an account over here for sales revenue. Sales for a total of 55,000. So I'm going to credit that account directly for 55,000. Now, I'm going to look over here to the balance sheet. Disregarding cash, is there another asset or liability connected to sales? So when we sell goods, does it impact one of these accounts over here? Well, yes, it does. It causes accounts receivable to go up. So when we have sales, often, typically, there is a debit to accounts receivable, and a credit to the sales revenue. Okay? All right. Let's go to the next transaction on the income. So the next transaction on the income statement is cost of goods sold. So let's go over and make our journal entry for that. So we're going to create an account over here for cost of goods sold. That was number 2, $30,000. So now I'm going to look, when I have cost of goods sold, what is the account over here that's impacted? So I look around and I see, well, inventory. When we sell goods, we give up inventory. So inventory will go down, $30,000. I'm going to just write a note to myself, that's for cost of goods sold. So cost of goods sold would have been debited, inventory was credited. Okay, so the next transaction is operating expenses. And it looks like really they're just breaking out operating expenses, but they also separate out for number 4, bad debt expense. Realistically, a company would have just combined those two to $14,198, and we would have seen operating expenses $14,198. But MixMax didn't do that in June. So we're going to have to, so operating expenses, let's go over and make our journal entry for this. Okay, so let's create an account for operating expenses. And we'll put our debit in for $12,198. And then we have to wonder, what are all of these expenses? So what would be the related accounts? Well, probably prepaid rent, right? Rent, prepaid rent goes up when we pay cash in advance, and it goes down when we incur rent expense. Right? It's going to go down when we incur rent expense. Sorry about that. So rent expense would be part of operating expenses. Cumulative depreciation, that goes up for depreciation expense. And here again, that depreciation expense is just plugged into this bucket, if you will. Just think of it as a big bucket of expenses. It's going to consist of rent expense and depreciation expense. Let's look to see if there's anything else. Interest payable is going to go up when we owe for interest expense. But now interest expense, if you flip back, I'm not going to do it right now, but if you flip back to MixMax's income statement, it has an interest expense account. So interest expense is not a part of this. Plus interest is not an operating activity. Interest expense doesn't get categorized under operations on the income statement. Of course, we'll see where it does get categorized as an operating activity on the cash flow statement. So that's always confusing. There's not a consistency there in how it's handled. Accounts payable, merchandise goes up when we purchase or buy goods, right? So that's not operating expense. And here we have accounts payable services. You want to think of that as that's things like utilities and salaries. So utilities and salaries. So it's going to go up, again for utility and salary expense. So our utilities, our electricity, phone, all of that. That's not applicable. Taxes payable goes up for income tax expense, but income tax expense is not an operating part of operating expenses. It's set out separately on the income statement, and then we'll talk about this. A deferred tax liability also is impacted with income tax expense. Saw that the other day in a lecture. Okay, so it looks like we have three accounts: prepaid rent, cumulative depreciation, and accounts payable services that operating expense impacts. So I'm going to actually just write out what would that journal entry, actually the accumulation of the journal entries for the month of June for MixMax. So if I added up all the debits to operating expenses, they would have totaled $12,198. And then we can see there had to have been a credit to prepaid rent. Of course, that reduces that account, $500. There had to have been a credit to accumulated depreciation. Of course, that causes that account to go up. We have to figure out how much that would be, don't we? And we have to figure out utility, this accounts payable, I'm just going to abbreviate it, accounts payable services also would have gone up. Well, we need to figure out, how much was depreciation expense for the month of June. Now, they did not sell this truck till the end of June. So when I go over here and look at monthly depreciation, actually, we would have included the truck. So let's calculate its monthly. $18,000 minus $1,800, and then divide by our 5 years, which is actually 60 months. So take $18,000 minus $1,800, divide that number by 6, and you'll get $270. So when I add up this monthly amount, I'm going to get $675. So the depreciation expense for the month of June was $675. Okay, so let's put our $675 in here. Instead of debiting depreciation expense, in essence, they're putting in this bucket of operating expense and crediting accumulated depreciation. And then I'm just going to plug, what I need over here to accounts payable services. So $12,198 minus $500 minus $675 gives me $11,023. And that would have been, if I accumulated all the journal entries for operating expenses, this would have been all the debits, and here would have been all the credits. Okay, so let's go post this then in our on a worksheet. So we already have the debit. Let's go to prepaid rent, post our credit, transaction 3, accumulated depreciation, let's post our credit, transaction 3, and accounts payable services are $11,023, transaction 3. So I have a debit here, and I have credit, 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 and we're in balance. Okay, going back to our income statement, the next one is bad debt expense for $2,000. Let's record. Okay, so let's create an account for bad debt expense. And $2,000. Transaction 4 for our worksheet. Now, what's the related account over here? Well, the allowance account goes up for estimated bad debt expense. So we learned that in Chapter 7 last term in intermediate 1. So remember, the allowance account goes up for the estimated amount. So it goes up for what we estimate, and it's going to go down for actual bad accounts written off. So bad debt expense, which is an estimated amount, causes the account to go up. Okay, let's go look at what else to record. Okay, so we've made sales as cost of goods sold, our two expenses. Of course, this is not an account, operating income. The next one will be interest expense, 422. So let's create an interest expense account. Number 5 for $422. And then I look to see, is there a related account over here? Well, there is, because interest payable goes up when we incur interest expense and owe money. So this account went up when we incur the expense and we owe money. So we have a debit to interest expense, a credit to interest payable. Next item is this loss on sale of property, plant, and equipment, $380. So let's put our loss here, and $380. Well, when we incur a loss, that's from selling the truck, right? So normally what we have is that transaction would include a debit to accumulated depreciation to reduce it. It would include a credit to property, plant, and equipment to remove cost, right? So we remove book value. We reduce cost out of property, plant, and equipment and the accumulated depreciation. So we remove book value. Cash comes in. I'm going to put it down here. Cash comes in, and the difference is a gain or loss. Well, the income statement is telling us it's a loss. So I'm going to go ahead and start figuring out my journal entry. So I know the loss is $380. Let's go to these two accounts on the balance sheet and see if we can figure out those dollar amounts. So let's go over to accumulated depreciation. Well, the account went up $675. But overall, on the balance sheet, from the beginning to the end of the period, it went down a total of $945. So there had to have been credits during the month of $1,620. There had to have been a credit of $1,620 with this debit of $675 for an overall decrease in that account of $945. We say that again. There had to have been credits less this debit for depreciation expense to cause the account on the balance sheet to go down $945. So this is from the sale of property, plant, and equipment. So I can solve the balance sheet. Now I can tell the income statement told me this. Now on problem solving, there had to have been a debit of $1,620. So I've got my two debits figured out. And by the way, with this MixMax, you're going to see the crisscrosses. If I just add those two, I'll get this 1620, and that equals 1620, and of course this is 0, right? Because nothing happened there. So the crisscrosses equal 945 and 675 equals 1620. Let's go up to property, plant, and equipment. Well, it went down $18,000. So that had to have been, I'm going to put that credit over here in my journal entry. So the journal entry must have involved a credit to property, plant, and equipment of $18,000, a debit to accumulated depreciation of $1,620, and there was a loss. So now I can just plug, well, how much did we sell this for? I'm going to put it in green since it's a cash flow. So we must have sold this for $16,000. And by the way, let's go back. We said $16,000. Let's go look at the cash flow statement that the author of the case gave us to see if we agree. Okay, so when we turn back here, yes, we do see $16,000 cash in is what we received from that truck. So we are in agreement. Great. Okay, we have already posted most of this. We have the loss, we have the accumulated depreciation, and the $18,000 for property, plant, and equipment. What we haven't recorded here is the cash coming in of $16,000. So let's go ahead and do that. But before I put it in the cash account here, I have to classify. If it's an operating activity, I'm going to put it here for cash from operations. If it's financing, I'll put it here. And if it's investing, I'll put it here. So let's just sort of review a little bit. So just a quick review. We classify cash flows as financing if it involves long-term debt and stockholders' equity. That's financing. It's an investing transaction if it involves long-term assets. So cash coming in or out is investing. And that's what we have, right? The truck is a long-term asset, so we're going to see that $16,000 is going to be an investing activity. And then everything else is operating. And we'll get into that a little. Well, I've already gone over that in an earlier lecture. Okay, so let's post an investing activity. I'm going to put that $16,000 here for cash. And that's number 6. And I want to write a little description. You know, that was the sale of the truck. Or property, plant, and equipment, I guess, is how MixMax classified it. So I do need to put a little description because I would have to describe it on the cash flow statement. So describe it here so you're not having to come back and try to remember when you prepare your cash flow statement. Okay, it looks like we have still something else on the income statement. Let's go look. Last item is this income tax expense, $4,000. So let's go record it. Okay, so let's set up an account for income tax expense. And put our debit of $4,000 in there. Okay, and then the other day, or the other recording I should say, depending on when you're listening to this, we saw, now we're going to break this out between, we have 2 accounts related to income tax expense. So we are going to break that out like this. So income tax expense, $4,000. Part of it's going to go to that deferred tax liability account, which is, since it has 198, we're just going to plug 198 to take care of that, and we'll plug the difference to taxes payable. So I'm just going to plug, what do I need to make this balance? I need $3,802. So I just plug that. Okay, so let's post the 198 here. It's transaction 7, so make a note, and then 3802 over here. Okay, so that's all the revenue and expense on the income statement, but there also is net income. So let's go take a peek at that. We also have net income of $6,000. We're going to make a closing, right? We close revenue expenses and net income gets closed to retained earnings. So let's go put our closing entry on our worksheet. Okay, so we have a closing entry. Remember closing entries? We close out all the revenue, so by debiting sales, and we close out all expenses by crediting those. So just go down and close everything out. So after this closing entry, all the revenue expense and the loss account, all of those have 0 balances. Now if I were to write this out, I have a debit and I have all these credits. I'm still not in balance. I would need another credit of $6,000, and that's going to go to net income. Excuse me, to retained earnings. And that is net income. So the $55,000 minus all of these in red is, the difference is $6,000. That is net income, and that goes to retained earnings. Okay, well, the next step is solving for cash flow. So we've looked at what caused a change in the balance sheet accounts. That's what's in black. We entered in over here on our balance sheet account what's the impact of the income statement transactions. And really we're going to see now the only thing left in these balance sheet accounts are cash flows, cash transactions. So let's start solving for them. Well, let's look at the allowance account. The allowance account goes up for estimated bad debt expense. By the way, this is going to be an exception to what I just said. And it will go down for actual. So we're writing off accounts. So if the account went up $1,500 from beginning to end, there had to have been, a debit of $500 to make that happen. Because during the month, there were credits of 2,000, debits of 500, for an overall increase of $1,500. And again, I'm going to make a note here. This is due to write-offs. So just, a refresher back on, Chapter 7 on accounts receivable. Write-offs cause the allowance account to go down. And I'm going to make that transaction A. So I'm going to move away from numbers. So the write-off is 500. Well, what was the credit? Well, when we write off actual accounts, we take that out of accounts receivable. So let's make a note. That's for write-offs. So actual bad accounts, we remove them from accounts receivable and the allowance account. So we have a debit and a credit. Now, what else causes accounts receivable to go down? Accounts receivable goes up for sales revenue. It goes down when we write off bad accounts. And it goes up when we collect cash. It also goes down when we collect cash. Let me say that again. It goes up when we have credit sales and customers owe us money. And there's only two things that can happen, right, if customers owe us money. Either we will collect it or we don't and we write it off. So again, if customers owe us money in the future, either we get our money from them or we don't and write them off. So now I got to figure out, okay, if the account went up $4,000, sales exceeded these two by $4,000, right? Sales, if the count went up from beginning to end, sales exceeded the collections and write-offs. So I just got to figure out, 55,000, minus this, minus that equals $4,000, and you should get this to be 50,500. And here again on the MixMax, you can do your crisscrosses as a shortcut. So 4,000 plus 500 plus 50,500 is going to equal your $55,000. Okay, the crisscrosses will work. Let's make this transaction B. So cash came in. Let's go over to the cash account and categorize it. Cash collected from customers is actually an operating activity. 50,500. Transaction A. And I'm just going to write customers, but I would actually say cash collected from customers, 50,500. So I have a debit and a credit. So let's look at bigger picture here. We took sales revenue and converted that to cash basis, cash that actually came in at 50,500. That's what we really did. And actually, I guess we took sales and we had to factor in our bad debt expense as well. Those two together, we had to weave those through these two accounts because they're interconnected, aren't they? We weaved it through these two accounts to get total cash collected. And I'm going to go ahead. I know that's going to run into my credits when I get to doing that. So let me erase this side of that. Okay. So we've converted accrual to cash basis. Let's go down here to inventory. Well, inventory goes down for goods sold, for the cost of goods sold, and it's going to go up when we buy goods, right? So we got to figure out if it went up overall, if the volume of inventory went up, it's because we bought more than we sold. Well, how much did we sell? Well, we must have sold 36,000. So that's going to be item C. So 36,000 minus 30,000 is an overall increase of 6. 36 minus 30 is an overall increase of 6. When we buy goods, if there is an accounts payable merchandise, that tells me we buy on credit. So this account would go up as well. So MixMax would have debited inventory for purchases and credited accounts payable merchandise. Now, what causes accounts payable merchandise to go down? Because we pay cash. So if the account went up, we bought more and we collected. So, getting your numbers to work out, 36,000 minus the 3,500, we must have collected 32,500. And we'll make that transaction D. So cash paid out is 32,500. So we bought 36,000, we paid cash of 32,500. And again, you can get your crisscrosses to equal that 36,000. If cash is paid out, cash is going to go down. So put this 32,500 on the downside. Transaction D. And I need a little description there. I can't squeeze it in, but you probably can. That's cash paid to suppliers of merchandise. So suppliers really would go there. I'm going to write it there just so you can read what I meant to write. Okay? So what we did is we converted a cost of goods sold expense on accrual basis to cash paid for merchandise. Okay, let's keep going. So we have that's in balance, that account's in balance. No cash was paid out for prepaid rent. Prepaid rent goes up when we pay cash. It goes down when we use the rent, which is rent expense. So it's in balance. This account's in balance. We didn't buy, right? It goes up when we buy equipment. It goes down when we sell it. Cumulative depreciation is in balance, so nothing else to do there. Interest payable. Interest payable actually went down. That's because we paid more cash than the actual expense. That would be because we paid the beginning balance plus a bunch of this expense, okay? And that is why the balance sheet account could go down. So add these two together, I'll get $428. I think I'm ready for E. $428 was cash paid for interest. Now here's the thing. Interest expense is a non-operating activity on the income statement, but cash paid for interest at $428 is categorized as an operating activity on the cash flow. I'll just put I, so cash paid for interest. So we have cash coming in from customers, cash paid for to suppliers for merchandise, cash paid for interest, $428. Nothing with dividends payable, that account is in balance. Accounts payable services, it went up, so that means the expense exceeds the cash payment. So the cash payment, if I take the difference in these two, is $7,472, transaction F. $7,472. I add these two together, that agree with 11,023. Cash paid for services is an operating activity. So I'm just going to put services there. Cash paid for services, $7,472. Next one, current portion of debt goes up when we borrow money, and it's going to go down when we pay our creditors. So there had to have been a credit, right? Our crisscrosses have to equal. So they had to have debited this account because they paid cash out. So now current portion of debt, that's really current portion of long-term debt. If I make a payment on long-term debt, that's a financing activity. So we'll put that 573 here. You know, that's a debt payment. So 573, debt payment. Taxes payable goes up for the expense. It goes down when cash is paid. So if the account went down overall, we paid a lot more cash than the expense. So add those two together and we will get $28,202. Transaction $28,202. And again, that's because there had to have been a large beginning balance in taxes payable. We're paying that beginning balance plus some of this income tax expense for the account to have gone down overall. Okay, cash paid for most expenses, cash paid for expenses is operating. So $28,202 cash paid for taxes. Alright, nothing happened with long-term debt. It goes up when we borrow money, it goes down when we pay it. Deferred tax liability goes up for the expense, and we didn't have any decreases this period. And we'll hold off. Actually, you'll see that in your next course in accounting. We're just going to see increases throughout this semester. But next term, you're going to see where the account can actually go down. Okay, we saw for all of this. Let's go over to retained earnings. We're not in balance. Retained earnings only went up $4,700, even though net income is $6,000. So there had to have been a decrease of $1,300 to retained earnings. Well, what would cause that to go down? I'm going to make that transaction I. Well, what causes retained earnings to go down? Dividends. So we paid dividends of $1,300. Cash paid for long-term debt and stockholder equity is a financing activity. So that 1,300 is going to go here on the cash flow statement and write a little description, dividends. Okay, let's see if everything balances. So I'm going to do the operating activities, 50,500, subtract those four, and I will get a negative 18,102. Then I'm going to take that 18,102, add the 16,000, subtract these two here, and you will see that will agree to this 3,975. And when that happens, you're in balance. When you're in balance like that, you must have done it right. The only thing you might have gotten wrong would be misclassifying the cash flow. And let's go back. We should see, these numbers, the operating 18,102, we should see these three numbers also on the cash flow statement. And we do. Here's our 18,102 from operating. Here's our two financing, repayment of the loan and the dividends, and then our sale of the truck. So yes, we are in agreement. Okay, the next thing I'm going to talk about is the indirect method. There are two methods for reporting cash flow. So let's look at the indirect approach. Okay, so if you want to flip to this particular page, the reality is, whether I use the direct or the indirect approach, the investing and financing categories, I problem solve and I report those exactly the same. The category that gets problem solved and reported differently is the operating activity category. So here's really our 5 steps. Step number 1, we'll start with net income, and then we're going to take anything out that's not a cash flow. So depreciation expense, I add that back because it's not a cash payment. And then I want to remove anything that's not operating because we only want operating activities. So any gains and losses from property, plant, and equipment, because those are investing activities, I remove that. Step number 4, enter in the changes in the current assets and current liabilities. And I'll get to this here in a little bit. But basically, those first 4 steps are the big component of arriving at cash from operations. So let's go back and look at that a little closer. So I've gone over this before. On the sales account, we know that's related to these 2 accounts on the balance sheet. Actually, I haven't factored in bad debt expense here, did I? But ignoring that, sales, we weave it through these 2 accounts, and again, we didn't have unearned revenue in June, but if we did, we would have to factor that in. We arrive at cash collected from customers. Cost of goods sold impacts inventory, which impacts purchases, which impacts accounts payable, and we arrive at cash paid for suppliers. So I'm just going through. If you look back what we did in the big picture, we took all these income statement accounts, weaved them through the related balance sheet account, and we arrived at these cash flows. One exception is that depreciation is never a cash flow, right? We don't pay cash for depreciation. It's just an accounting entry. So that's really not factored in. But if you look at all of these, this is a current asset, that's a current liability. Current asset, current liability. Current asset, current liability. Current liability, I'm going to ignore that for now, and current liability, I'm going to ignore that for now. So the common factor here is that our current assets and current liabilities are very much connected in with revenue and expenses. So let's go back through those steps again. Step number 1 was to take net income. Step number 2 was to remove anything that's not a cash flow. Well, depreciation expense is not a cash flow, so we remove it by adding it back. Right? All expenses. We took revenue minus expenses, so if I want to remove depreciation, I add it back. Step number 3 is to remove anything that's not operating. Well, if we had gains and losses, which I don't have here, from sale of property, plant, and equipment, those aren't operating activities. So I need to remove those. So I would do that by subtracting the gain or adding back the loss. So again, losses are subtracted, so I would add it to remove it. And again, those are not operating activities. Those are investing activities. So I would need to remove that from net income if I'm only solving for cash from operations. So that's why step 1, 2, 3, and then here's step number 4. That is the large component of arriving at this cash from operation. However, now in MixMax, we're seeing a little bit more complicated topic. That's this deferred tax liability. So in addition to that, not only I'm going to factor in the changes in current assets and current liabilities, but because this long-term account is also connected to income tax expense, I'm going to look at it as well. And by the way, we haven't gotten to the premium and discount on bonds, so we're not going to talk about that today. Okay, so we won't talk about that. But the deferred tax liability, that's the new thing here in MixMax. So step 1, 2, 3, 4, 5, and then we arrive at cash from operations. So here we go. So we have remove non-cash, remove non-operating, enter in the changes in current assets and current liabilities. We're going to factor in the change in deferred tax liability. We'll get to this later. And the result is cash from operations. So let's go do that on our T accounts. Okay, so step number 1 was to start with net income. So I'm going to start with net income, and I can find it in the retained earnings account. Don't do the $4,700. It's the $6,000 that's in retained earnings. So I'm going to start with net income. That's a positive, so I'm going to put it on the positive side here, a $6,000. Second step is to remove the non-cash. Well, we know depreciation expense component and that operating expense was $675. So I'm going to add back depreciation expense, which is a non-cash activity, add it back, so put it on the positive side. Step 3, remove any non-operating activity. Well, that would be this loss on the income statement. And the loss, again, are subtracted, so I want to add it when I get over here. This is 380. So that's step 1, 2, and 3. Okay? So it's take net income, add back non-cash activities, add back the loss, or subtract the gain if I have it. The next step is just to look at these changes in current assets and current liabilities that are connected to operating activities. So I'm only factoring in the change. So the allowance for doubtful accounts went up. Now here's where I really like MixMax, because you can just plug your debits and credits here. Excuse me. So this went up, which is a credit. So I'm just going to debit it down here, $1,500. So I have a debit and a credit. And then I'm going to write a description, an increase in the allowance for doubtful accounts, $1,500. Accounts receivable went up, $4,000. That's a debit. I'm going to put it over here as a credit, $4,000. Increase accounts receivable, and I need to describe what it is. Inventory also went up. That's on the debit side. So I'll go down here and put it on the credit side. And my little description, increase in inventory. Prepaid rent went down. That's a credit. So put it on the debit side when I go over here. So I have decreased prepaid rent, $500. Property, plant, and equipment went down, but it's not a current asset, so I don't do anything with it. Likewise, accumulated depreciation. It's a long-term account, so I ignore it. Interest payable went down. That's on the debit side. So when I go down here, I'm going to put it as a credit. I'm just going to do IP for interest payable. So I have a debit, credit. Nothing on dividends payable. Accounts payable merchandise went up. That's on the credit side. Put it over here as a debit. And write your description. Increase accounts payable merchandise. Accounts payable services went up on the credit side. So put it down here on the debit. Increase accounts payable services. Current portion of debt did go up. but that is a financing activity. So even though that's a current liability, I don't do anything with it because that is connected to long-term debt and a financing activity. Taxes payable went down. That's on the debit side. So put it over here on the credit side. 2,400. I ignore long-term. Normally I ignore all long-term, except the exception is this deferred tax liability. It went up on the credit. Put it over here on the debit side. Deferred tax liability. Okay, then I'm going to add all of my debits, subtract all the credits, and I will get cash from operations a negative 18,102. And that should agree with the direct method. So under the direct method, it would look like this. Under the indirect method, it looks, like this. But either way, the bottom line, cash from operations a negative 18,102, a negative 18,102. Okay, let's stop and look at, well, if we write out the cash flow statement for the direct versus the indirect method, what is it going to look like? So if I go to my T accounts and under the direct approach, in the cash account, I've got a positive 50,500, and then I have these credits. And I just write the description. That's why I wanted you to write a little word by your within your T account. So when I net all those, I get this negative 18,102. And then financing activities, I have these two, cash paid on the loan, dividends paid, and then the investing activity, cash proceeds from the sale of truck. So I net the three activities, I get a decrease in cash, add that to the beginning balance, and this ending cash balance, I should see that on the balance sheet. Now, the indirect method, what I want to point out, look at all this at the bottom. It's identical. So whether, financing and investing activities, those all get problem solved and reported exactly the same way. It's this cash from operations that's different. So in our T account for the indirect method, we had all of these on the debit side and all of these on the credit. And this is exactly how I would write it out. We start with net income of $6,000, and we add depreciation expense, the loss on the sale of property, plant, and equipment. And then all these changes in current assets and current liabilities, I say, I have to tell, the allowance account went up, prepaid rent went down. These three liabilities accounts went up. Then I subtract the increase in these two current assets and a decrease in these two current liabilities. Either way, I get the same negative 18,102. So again, I want to point out, it's just, different strokes for different folks. All of us reading the cash flow statement much prefer the direct method. It's very clear, isn't it? This is easy to understand, very easy to understand what happened to cash. Over here, that's very confusing to read and understand. But the reality is that most companies, something like 95% of companies, use the indirect approach. I'll also say that's likely to change down the road. The international standards are moving towards the direct approach, so we can kind of look to anticipate probably the U.S. standards, the American standards, likely will follow along with that.